Welcome to the channel. Today we're going to show high earners why staying loyal to a single, traditional bank can quietly cost thousands in lost interest every year. We'll replace the one-size-fits-all approach with a two-account strategy. One account for day-to-day convenience and another for optimizing yield. We'll also cover brokerage cash management accounts, high-yield savings accounts, how to position a $40,000 emergency fund, where to put your surplus, and how to automate all of it. This is an educational overview, not individualized financial advice. Here's our roadmap. First, we'll explain why loyalty to a single bank can be expensive. Then we'll break down the two-account strategy. Next, we'll detail how to position a $40,000 emergency fund. We'll compare cash management accounts and high-yield savings. We'll show how to invest surplus capital, give you an action plan to automate the whole system, test your knowledge with quick quizzes, and end with risks, nuances, and a disclaimer. The problem is simple. Many traditional national banks pay extremely low interest on savings, especially on large balances. If you leave significant cash parked there for convenience, you're giving up meaningful yield month after month. The smarter approach is to keep the convenience benefits for bill pay and quick access while moving serious savings to higher yield platforms designed to work for you. Here's the two-account system. First, a primary checking account dedicated to convenience, bill pay, mortgage, and quick ATM access. This can be a local credit union, a strong regional bank, or a major national bank with a robust branch network and low fees. Second, a yield-focused account where your serious cash lives. That can be a high-yield savings account or a brokerage cash management account that sweeps into money market funds. The key is automation. As income hits checking on payday, you automatically transfer a portion to the high-yield account to build and maintain a 6-month emergency fund. Any surplus above that target is routed to long-term investments like retirement accounts or suitable midterm vehicles. Cash management accounts mimic checking features, but sweep idle cash to money market funds to improve yield. Many reimburse ATM fees worldwide, and the overall package can be very flexible. However, insurance differs. Brokerage accounts are covered by SIPC for securities and cash up to stated limits, but money market mutual funds are not FDIC insured, even if they invest in very safe instruments. Some brokerages also offer separate FDIC sweep programs. Details vary. High-yield online savings accounts are straightforward bank products. They typically pay competitive APY because they have fewer branches and less overhead. They are FDIC insured up to the legal limits per depositor, per bank, per ownership category. Transfers between HYSA and your checking usually take 1 to 3 business days, depending on cutoffs and networks. Either option can work. Pick based on features, insurance preferences, and convenience. This quick matrix summarizes distinctions. Brokerage cash management accounts can deliver competitive yields via money market sweeps and often reimburse ATM fees, but rely on SIPC, not FDIC, for brokerage protection, and money market funds are not FDIC insured. High-yield savings are FDIC insured up to legal limits and usually offer solid APY with simple features. Traditional banks can be convenient, but often pay low interest and may charge more fees. Evaluate based on your need for yield, insurance preferences, ATM usage, transfer speed, and branch access. For a substantial emergency fund, aim for approximately 6 months of essential expenses. As a working example, if that equals $40,000 in total, you might keep around 1 month's expenses in checking to ensure instant liquidity and put the remaining 5 months in a high-yield savings account or a brokerage cash management account to earn a better yield. If you ever tap the fund, set automated transfers to rebuild it back to target. The precise split should reflect your monthly burn rate, employer stability, and personal risk tolerance. Here are the steps. First, review your current accounts to identify idle cash. Second, set up or confirm a checking account at a local credit union, regional bank, or national bank that offers minimal fees and broad ATM access. Third, open a high-yield savings account or a brokerage cash management account with a competitive yield. Fourth, link the accounts and enable ACH transfers. Fifth, automate transfers from checking on each payday to the high-yield account. Sixth, build the emergency fund to around 6 months of essential expenses. Once the target is reached, stop adding to the emergency fund. Seventh, redirect any surplus to long-term investment vehicles, such as retirement accounts, diversified index funds in a taxable account, treasury ETFs, or no-penalty CDs for midterm flexibility. Eighth, Configure alerts for low balances, large transfers, and rate changes. Finally, review quarterly to ensure your APY remains competitive, fees stay low, and the automation is functioning correctly. This sequence diagram will show a typical monthly flow. Salary arrives from the employer to the checking account on payday. The checking account handles bill payments. An automated transfer sends a portion to the high-yield account to maintain the emergency fund. If cash is needed, ATM withdrawals occur from checking. At month end, if the high-yield balance exceeds the 6-month target, the surplus is transferred to investments such as Roth-IRA, 401k, or a taxable brokerage account. The diagram emphasizes automation and maintaining a small buffer in checking for stability. This timeline depicts the path to building a 6-month emergency fund. In week 1, you select the right accounts and open both checking and HYSA or CMA. In week 2, you link the accounts, verify microdeposits, and set up automated transfers aligned with your payday. Over weeks 3 to 6, you move idle cash and build to roughly 3 months of expenses. In month 2, reassess your expense baseline and adjust your target if needed. By months 3 to 4, you reach 4 to 5 months, while keeping a 1-month buffer in checking. By months 5 to 6, you hit the full 6-month target in the high-yield account. From month 7 onward, you stop contributions to the emergency fund and redirect surplus to investments, with quarterly reviews baked in. Quiz time. The question is, where is the best place to keep a large emergency fund for yield and safety while maintaining reasonable access? Option A, in your primary checking account. Option B, in a traditional big bank savings account paying near 0%. Option C, in a high-yield savings account or a brokerage cash management account sweeping to high-quality money market funds. Option D, under a mattress. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. A high-yield savings account or a brokerage cash management account typically provides a competitive yield while maintaining reasonable access. High-yield savings accounts are FDIC insured up to legal limits. Brokerage cash management accounts use SIPC coverage for cash and securities, and the yield often comes from sweeping balances into money market mutual funds, which themselves are not FDIC insured. Verify account specifics to match your risk tolerance and needs. Here is the second quiz question. What is the primary job of your local or national checking account in this strategy? Option A, long-term wealth growth. Option B, convenience functions such as bill pay, mortgage management, and ATM access. Option C, holding your entire life savings. Option D, timing the stock market. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The checking account exists for convenience. It's where you pay bills, manage your mortgage, and access cash via ATMs. It is not the place to store large long-term savings. Serious savings should be held in a high-yield vehicle for better returns. Once your 6-month emergency fund is fully built, prioritize long-term growth. Capture any employer 401k match. Then consider maxing tax-advantaged accounts like an IRA or Roth-IRA if eligible. For additional investing, diversified index funds in a taxable account can serve long-term goals. For midterm needs, consider Treasury ETFs or no-penalty certificates of deposit to maintain liquidity while earning a competitive yield. Automate contributions where possible and rebalance periodically. Always consider taxes, your time horizon, and risk tolerance. Returns are not guaranteed and rates change. Understand the nuances. FDIC insurance protects bank deposits up to legal limits per depositor, per bank, per ownership category. SIPC protects brokerage customers up to its limits for cash and securities in the event a brokerage fails, but it does not insure against market losses. Money market mutual funds are not FDIC insured. Some brokerages offer separate FDIC sweep programs. Verify details. Transfer times, cutoff windows, and ACH networks affect access. Keep balances under insurance limits by diversifying across institutions and ownership categories as needed. Watch for fees, minimum balance requirements, and changing rates. Be aware that fraud protections on debit and ACH can differ from those on credit cards. Understand your bank's policies. Disclaimer. This content is educational and does not constitute financial, investment, or tax advice. Speak with a qualified professional who understands your personal circumstances. Rates, yields, insurance limits, and account features change frequently, so always verify current terms before implementing any strategy. Key points. Separate convenience functions from yield optimization by using checking for operations and HYSA or CMA for savings. Automate transfers to build and maintain a 6-month emergency fund. Once you hit the target, redirect surplus to long-term investments. Verify insurance types and limits, fees, and transfer speeds. Review quarterly to avoid being trapped by loyalty to low-yield accounts. Here's your action recap. Open or confirm a low-fee, high-convenience checking account. Open a high-yield savings account or a brokerage cash management account with a competitive yield. Automate transfers aligned with your payday. Build to approximately 6 months of essential expenses. Then stop adding to the emergency fund. Redirect excess cash to retirement and diversified investments. Review quarterly and adjust as rates and your life change. Thanks for watching. If this helped you stop leaving money on the table, please like the video, share it with a friend who earns well but parks cash at a low-yield bank, and subscribe for more practical strategies. In the comments, tell us how you're restructuring your accounts and which features matter most to you.